Hello and welcome to today's edition of Beyond Reasonable Doubt. My name is George Wong. I'm very excited to share this topic with you. Just for a reminder, this is Life Insurance Awareness Month, September. And today's topic, we shall be looking at insurance as an investment. And we will focus on the compounding. Not because compounding is something unique to life insurance, but the difference in the life insurance environment compared to other environments is what we're going to focus on. So you may know it or not, so compound interest is famously known as the eighth wonder of the world. This was a bold statement by Albert Einstein. For those who know Albert Einstein, one of the geniuses, very intelligent, those smart old people. I'm going to introduce you into the topic, and then before I share some content for your visual retention. Thank you, and follow on. As you follow along, I want you to keep this at the back of your mind. Investment strategy. I want to show how life insurance works as an investment vehicle. So this is not selling one product over the other, but the more you know about different environments, you can take advantage of them. And think of it, instead of a product, you look at it as a strategy. And most people who invest, they are investing for long-term security, most of that being a retirement income. So if that is the case for you, you keep your focus and attention here. So look at this, for example, on a timeline. On a standard retirement saving plan, for those of you who live in Canada, RRSP, Registered Retirement Saving Plan. If you're using that plan for your retirement, this is what happens. You have a contribution phase up to a certain age in Canada where you retire. Is the age 65. And after that, let me use another color. After that, you have the withdrawal phase. So how long can that sustain you when you start withdrawing at retirement? You withdraw until it will come down to zero. So that is a standard RRSP plan. But this is a strategy for RRSP. How about I show you a strategy where this compounding from the contribution phase, let me put this as contribution phase and withdrawal phase. So how about we don't interrupt this compounding from the contribution phase, and instead of withdrawing here, we let it continue to compound and grow. How about that? How does that sound to you? Have you known something like that before? If you know, good for you. Let's assume that you, in the contribution phase, you made up to about $1 million, and you start withdrawing it and you run out at some point from age 65, let's say, to age 80, and you run out of cash. That's about 15 years old. Here is the power of the collateral strategy, or the compounding without interrupting compounding. I would really like you to search this, the eighth wonder of the world, compound interest, eighth wonder of the world. It will help you understand the power of compounding, and the fact that you don't interrupt that compounding is really powerful to you. And by the way, as a side note, it works well for savings as it works for debt. So those who borrow money, watch out for that. There's also compounding in the debt side. So which side do you want to be? On the saving side for the compounding to help you, or on the debt side for the compounding to kill you? So something to take note of. So with the compounding within the life insurance environment, you are able to use the strategy of collateral. So not withdrawing at retirement from your life insurance plan, but instead you are using a collateral loan where you start from $0 from the first year of withdrawal. You are taking a collateral loan against your insurance policy. So by the time the collateral loan will ever catch up with your cash value in the life insurance, it will allow you so many years down the road. If you can figure that out, it will allow you so many years down the road, so you'll be able to withdraw as much cash from there, allowing the policy to continue compounding for as long as possible. So this is just a tip of the iceberg. Now I'm going to show you some values so you can understand in perspective. This was a visual illustration for your retention. So you remember I talked about the contribution phase and the withdrawal phase. I'm going to use the laser here to point you to that. So I try to use a comparative analysis between RRSP, the retirement savings plan, and a life insurance vehicle as different strategies you use for saving for investment towards retirement income. So if you were to put about $600 a month towards your retirement in an RRSP, that will come to $7,200 a year. The equivalent of that amount, if you're putting this amount into a life insurance vehicle, that will be your after-tax dollar. So the equivalent will be $400 a month. After you have paid tax, you're putting $400 a month. That comes to $4,800 a year. So this is the contribution phase. By the end of, say, a 30-year period, so this is an individual, say 35 years old, you start contributing by the age of 65. That is 30 years of contribution. You would have put about $216,000 into RSP, and the equivalent into the insurance plan will be about $144,000. Here's what plays out in the withdrawal phase. During the withdrawal phase, from year 32, that is at 66 years old, going forward, when you start to withdraw the RSP, I assume that you're taking out $50,000 a year from the RSP plan and paying the taxes. It plays out from year number 66, just about 12 years to 13 years later, you already ran out of money from the RRSP and you're already in the red. So this is the RRSP column here. Meanwhile, with the insurance vehicle, the insurance strategy, the collateral that I explained, you're not touching anything from this account. Rather, it will continue to grow normally as if nobody was touching it. So it continues to compound. You do not interrupt the compounding effect of this account. See how much value, if you go up to age by 61, that is about 91 from age 35 to when you get to this point here, you'll be about 91 years old. So you would have accumulated up to 2.8 million into this insurance plan, up from the 44,000 that you put into the insurance plan. So we're going to look now on a graph so that you can see really visually. So to put things to perspective, here is the same numbers that I plotted on a graph so that you can see very well. The blue line here, this is the contribution for RRSP. The contribution phase is in green. You contribute up to 216,000. You remember this figure. And meanwhile, the black line is the contribution phase for the life insurance. And then let's say by the time you stop contribution, 30 years down the road, this would have accumulated interest up to about 600,000 here. So we are going from 600,000 downhill in an RRSP you're only withdrawing, so the amount goes down. As you withdraw, you're paying tax to the government at the same time, and you're taking out $50,000 every year as your retirement plan. So with that plan, with that amount of money, just it takes you from age 60 to about 75, roughly, approximately 75. That's 15 years. You already run out of cash. You're already on the negative. So here is where the power of compounding comes in and the collateral are combined together. In the life insurance environment, you do not withdraw the money directly. You allow it to continue to compound. It continues to compound up. And look at the yellow line. This is your collateral loan. So with the collateral loan, you are taking a collateral loan against your insurance, which you don't want to interrupt the compounding. So, but you're starting with the collateral loan at $0 from the first year, and you're taking out $50,000 as collateral loan every year. Similar thing, $50,000, whether in the RSP or in the life insurance. So, by the time the collateral loan will compound, don't forget compounding works even whether it's with the loan or with the saving. Before it will ever compound to catch up with the life insurance, look at how many years. You're already above 90 years. So meanwhile, in the RSP, about 75 years, you already ran out of cash. So the compounding goes to about 2.8 million. So anywhere along the line here, if you pass away while you're taking the collateral, the difference between the collateral and the life insurance will be the death benefit that will go to your family. So either way, you are winning. And so here you can see while you are alive, you're having your retirement benefit from here. If you pass away, the money goes to your family. You benefit either way. In the retirement plan, on the contrary, you only have the money to take. If you pass away, this will go into your estate, which will still come with some taxes involved into it. And by age 75, you already ran out of money. And if we consider the same period up to age 90, somebody with the RRSP would have been borrowing money, would be in negative 1.5 million to end up at the same point with somebody who had the other plan in the life insurance as a strategy. And this makes sense because while you are alive, you need to continue living. You need to find a way to survive on whether you borrow it from wherever. So look at, if you have to end at the same time, you are at minus 1.5 in order to meet at the same point with somebody who is in this. So something to take note about. So what strategy do you think is best fit for you? This is not to say that one product is better than the other. These products, they were designed for different clients for different needs. But however, looking at it as a strategy, you might want to consider which strategy fits you the best. Remember, at the end of the day, it is your dollar. It is making value for you, or is making value for some other person. So far now, besides the investment, I just like to reiterate, to mention this here. Are you looking at a product or a plan? Life insurance, there is many angles you can look at it. It's much bigger than a product. It's a plan, because in the same life insurance vehicle, now after you understand the power of investment within the life insurance, it comes with a critical illness which you can attach to it. So at any point in time, from age 35, when you start contributing, you're diagnosed with a critical illness, this layer can come off and can take care of things, and you get back on your feet and get back to work. At some point, you're running a business, you can jump into it and you can take some amount and empower yourself, drive your business. When it comes to retirement, I just showed you on the illustration how you can take out using the collateral strategy without interrupting the compounding, and you can take as much from inside, from within the plan. And then if you do pass away, at least It takes care of your estate, all the probate fees, which at some point I will talk about the probate. This helps to lessen the time of the probate process. It takes care of your estate with the money directly going to the named beneficiaries on the plan within a matter of weeks, and you still succeed to attain your objective of leaving a legacy to the next generation. You don't take everything with you. So is this really a product or is a plan? This is a kind of a life plan in my opinion. So now my challenge to you is do some comparison to yourself. Besides these many benefits highlighted here, we're just talking only about the investment strategy in the life insurance, besides many other benefits. So I challenge you, the numbers I use here are just for illustrative purposes, just to make you get a perspective of what actually transpires as a strategy, whether it's within an RSP or within life insurance as an investment vehicle. So put your own numbers together. For example, if I use you're putting $600 into an RSP versus $400 into the life insurance, assuming an average of 33% tax. This is Ontario province. Those are rough numbers, and you can put in your own numbers, but they are very, very, very much close to reality. But you get the perspective. I challenge you, compare it with any investment vehicle. Even some people think that some people today are thinking about using a life insurance as a comparative investment to a real estate property, for example. So put in the numbers. Why not try any investment vehicle? Compare. If you're putting into a real estate investment, so you put in $2,000, $3,000 a month into a mortgage, and then you put here, you compare apple to apple. And if you're paying property tax on all of that within a certain amount of time, you put this amount of money. What is the outcome? These are things that there are many calculators out there you can use by yourself and throw those numbers in, and you get the outcome for yourself. But by the way, if you're scared of those numbers, talk to your advisor. I think this slide here proves more reason to why you need a personal advisor. You can do it by yourself, and if you cannot do it, talk to your advisor. And if you don't have one, you can reach out to me. You have my contact there at any time to seek the help that you need. Thank you for following. And now I want to thank you for continuing to watch and support this effort. I would like to remind you, when I talk about collateral strategy, you're not able to collateralize RRSP because it's a registered account and it's tracked by the government. That's why when you withdraw money, you should be able to pay back the tax which you owe to the government into it. That's why it makes it more powerful. And with that collateral strategy, you use it in the life insurance environment. It really helps to strengthen the compounding by delaying it, making it compound much further, allowing it to become more powerful. Thank you for watching, and if you're still not subscribed, if you like what you see here, what you heard, please click on the like button. We will appreciate that. And if you want to get the notification for the next upcoming video, please subscribe to the channel so you get that immediately a video comes up. Your support is highly appreciated. Thank you, and watch out for the next episode.